Most Irish business owners spend decades building something real, a company, a reputation, a legacy. But when it comes time to sell or pass it on, they get hit with a massive tax bill. Capital gains tax in Ireland is 33%. So that can mean losing hundreds of thousands of euro in one go, but it doesn't have to be like that. Hi, I'm Kevin Elliott. I spent nearly 20 years working with global banks and hedge funds in London, New York. Today, I'm a financial planner based in Ireland, and I help Irish business owners exit their businesses by using proven legal strategies to reduce their capital gains tax. In this video, I'm going to show you two powerful reliefs, entrepreneur relief and retirement relief, which used correctly could save you up to 230,000 euro. That's money that you get to keep, not the tax man. In this video, we'll cover how each relief works, who qualifies, the landscape for 2025, and what it all means for you, your business, your family, and your future. Because if you don't plan for this properly, you could end up overpaying hundreds of thousands of euro in taxes. But if you do plan, you could protect your wealth, take control of your exit, and preserve the legacy that you've worked so hard for. So let's talk about entrepreneur relief. This relief is especially useful if you plan to sell your business to a third party or if you're selling through a company structure. It's designed to reward entrepreneurs by letting you keep more of what you've earned. But the catch is the criteria is extremely strict. Many business owners miss out, not because they didn't qualify, but because they didn't structure things properly in time. So entrepreneur relief is a tax incentive created to encourage entrepreneurship in Ireland. Instead of paying 33% capital gains tax, you will pay just 10%, but only in the first 1 million euro of lifetime gains. Anything above this, you will pay the standard 33%. This means that you could save up to 230,000 euro in tax. So you may qualify for it if you're a sole trader selling business assets, a partner in a trading partnership, a shareholder in a qualifying trading company, or you're part of a qualifying group of companies. Now, what assets qualify? So there's shares in a trading company, goodwill or business assets in a sole trade or partnership, assets used by a trading partnership, but not everything qualifies. So let's look at what doesn't. Shares or securities held in it for investment, development land, assets with no chargeable gains, property held personally but used in your company, goodwill transferred to a connected party or company, shares where you stay connected to the company after the sale. These exclusions are why structures really matter, especially if you're a director and you hold assets in your own name. So, conditions to qualify for these shareholders: you must own at least 5% of the ordinary shares in the company, be a director or an employee, work in a managerial or technical role, and have held these for at least 3 of the last 5 years. For sole traders or partners, you must have owned the assets for 3 years and use them in a qualifying trade. So let's look at an example where this works. Share buybacks, double holding companies, partner exits from trading partnerships. Another thing people get caught out is the deadlines. If you sell your business assets between January and November, you must pay the revenue by the 15th of December of the same year. If you sell your business assets in December, you must pay by January 31st of the following year. If you miss the deadline, you will pay interest and significant penalties to revenue. So let's look at some practical tips. Review your shareholding and employment history. Move personally held business use assets into the company well in advance. Speak with a tax advisor. Don't assume you qualify. Track how much of your 1 million euro lifetime you've already used. So let's look at an example. Mark. He's 59. He runs an electrical contracting business in Galway. He's a sole trader. After 20 years, he is selling his business for 900,000 euro, which includes his client list, equipment, and goodwill. So Mark qualifies. He's owned the business for more than 3 years, so therefore it's a qualifying trade, and the assets he's selling meet the criteria. Now, let's do the maths. At 33% tax, he would owe 900,000 euro times 33%, which is 297,000 euro. But with entrepreneur relief at 10%, it's 900,000 times 10%, which is 90,000 euro. That's money that Mark can use to retire, invest, or help his family. Now, imagine Mark hadn't spoke to a financial planner or wealth manager. He would have missed out on this completely and overpaid his taxes by 200,000 euro. Now, while entrepreneur relief is geared towards those selling externally or through a formalized structure, retirement relief is often the go-to for family business owners, especially those looking to pass on the business to the next generation. So now let's look at retirement relief. Despite its name, you don't actually have to retire to claim it. This is a capital gains exemption. It applies to someone aged 55 or older who disposes of a business asset. This includes shares in a family trading business, and it can mean paying no CGT at all if you meet the right conditions. So in broad terms, how it works is you must have owned and managed the business for at least 10 years. You must be age 55 or older, and you're either transferring the business to your family or selling it to someone else. There are two different types of relief. One where you're transferring to the family, and the other where you're transferring to a third party through a seal. So let's look at where you're transferring within the family. This means you're passing your business to your children, or sometimes a niece or nephew who happen to work full-time in the business for at least 5 years. So what is the relief? For ages 55 to 69, the lifetime limit will be 10 million euro. From age 70 onwards, it drops back to 3 million euro. So the timing is critical, because if your business is worth more than the limit, you could face a tax of 33% on the excess. And here is the deeper issue. When passing a business to a child, no money may exchange hands, but you're still taxed on the value without getting cash to pay the bill. This is called a dry tax charge. A few years ago, the Tax Commission recommended payment deferral options, but so far nothing has been implemented. So what are the risks with this approach? Well, families may delay succession, causing operational risks in the business, or they may sell to outsiders instead, losing family or local control. So now let's look at the other option, which is transferring to third parties. If you're willing to sell your business to someone outside the family, you may still qualify for retirement relief, but the rules are stricter, and there are value caps that you need to know about. The current rules, if you're aged between 55 and 69, the lifetime CGT exemption is 750,000 euro. But once you drop to 70, the CGT exemption drops to 500,000 euro. Anything above those limits is subject to capital gains tax at 33%. But there is one important safety valve, and it is called marginal relief. Marginal relief is designed to soften the impact. It stops you from losing all your tax relief just because you've gone slightly above the cap. Instead of paying tax at a full 33%, your CGT is capped at 50% of the amount above the exemption limit. So let's look at an example. Let's say you're 60 and you sell your business for 1 million euro. You're qualified for retirement relief, so the first 750,000 euros tax-free, leaving the in excess of 250,000 euro. With margin relief, your CGT is capped at 50% of that 250, which is 125,000 euro. That is the maximum amount of tax that you will pay. But without the margin relief, your 250,000 euro times 33% is only 82,500. This number is obviously lower than the maximum 125,000 euro under marginal relief. So in this example, you would not avail of the marginal relief. So remember, once you turn 70, your tax-free cap drops to 500,000. So if you're currently in your late 60s, selling before 70 could save you a 6-figure tax bill. Other conditions that you need to meet: you must be actively involved in the business. The assets must be qualifying business or farm assets. And if you're transferring shares, the company must be a family company. So you must own at least 25% voting rights, or own 10% personally, with your family holding the other 75%. Some practical tips: you must use the market value of the business even if no money changes hands. You must formally claim the relief in your tax return, and you need to keep all records for at least 6 years. Always get a professional valuation to support your claim and avoid revenue challenges. And watch out for clawbacks. If the person you transfer or sell a business to sells it within 6 years, the CGT relief that you got could be clawed back and they will owe the tax. So a summary of the lifetime limits: if you're transferring your business within the family and you're aged 55 to 69, you can claim up to 10 million euro tax-free. Once you hit 70, that limit drops to 3 million. If you're selling to a third party and your age is between 55 and 69, you can claim up to 750,000 tax-free. But once you hit 70, that threshold drops to 500,000. So again, the message is very simple. The older you get, the lower your tax-free cap. And that makes timing your exit even more important. If you're nearing 55, now is the time to act. The 2025 rule changes have created a narrower window of opportunity, and that window may not be open again. Whether you're planning to sell your business or pass it to your children, the timing between now and your next birthday could mean a 6-figure difference. So what should you do? Work with a qualified tax advisor or financial planner. Model out all your options, plan your structure, sequence, and timing carefully, because when the rules shift, your strategy should also. Some business owners may qualify for both entrepreneur relief and retirement relief, but here's the catch: you can only claim one per disposal. So which one should you choose? Well, it depends on a number of factors: your age, your ownership structure, whether you're selling to a third party or family, and the timing of the transaction. There is no one-size-fits-all answer. That's why professional advice is essential. A financial planner or tax advisor can help you run through the numbers, and you can choose the most efficient path that works for you and your family. But remember, exiting your business is not the end. It's the start of your next financial chapter. From this point forward, it's about protecting your assets, ensuring liquidity, and ensuring a lasting legacy. Let's connect this to inheritance tax. Under current rules, your children can receive up to €400,000 tax-free. Anything above that is taxed at 33%. If you don't plan ahead, your family could face a major tax bill on wealth that you've built. But if you align your capital gains and your capital acquisition tax strategies now, you'll keep more and pass on more to your family. So what does this all mean? These tax reliefs aren't just loopholes or technicalities, they are strategic tools for business succession and family wealth. And in today's environment, timing has never mattered more. Whether you plan to sell or pass on your business, the decision you make now could make the difference between paying 33% tax or paying nothing at all. Because exiting your business is more than a transaction. It's a turning point. It's where wealth shifts from being active and exposed to protected, purposeful, and ready for the next chapter. Here are a few key takeaways. Start planning at least 5 years in advance. Make sure you meet the conditions for CGT reliefs. Time your exit strategically, especially if you're near a key age threshold. Don't be fooled by the name. You don't have to retire if you claim retirement relief. Staying involved after the sale does not disqualify you. And most importantly, coordinate your capital gains and your capital acquisition tax. That's how you maximize what you keep and what you get to pass on. If you're a business owner thinking about an exit in the next 5 to 10 years, now is the time to start planning. And check out my video on capital acquisition tax in Ireland. Please leave a comment if you've got a question or you've got a story to share, because your exit shouldn't just be a transaction, it should be efficient, strategic, and built around the legacy that you want to leave behind.